continued to present the problems mentioned in the January 1967 letter. And 4. My own personal interests dictate a less compulsive approach to superior investment results than when I was younger and leaner. Let's look at each of these factors in more detail. The evaluation of securities and businesses for investment purposes has always involved a mixture of qualitative and quantitative factors. At the one extreme, the analyst exclusively oriented to qualitative factors would say, buy the right company with the right prospects, inherent industry conditions, management, etc., and the price will take care of itself. On the other hand, the quantitative spokesman would say, buy at the right price, and the company and stock will take care of itself. As is so often the pleasant result in the securities world, money can be made with either approach. And, of course, any analyst combines the two to some extent. His classification in either school would depend on the relative weight he assigns to the various factors, and not to his consideration of one group of factors to the exclusion of the other group. Interestingly enough, although I consider myself to be primarily in the quantitative school, and as I write this, no one has come back from recess. I may be the only one left in the class. The really sensational ideas I have had over the years have been heavily weighted toward the qualitative side, where I have had a high probability insight. This is what causes the cash register to really sing. However, it is an infrequent occurrence, as insights usually are, and of course no insight is required on the quantitative side. The figures should hit you over the head with a baseball bat. So the really big money tends to be made by investors who are right on qualitative decisions, but, at least in my opinion, the more sure money tends to be made on the obvious quantitative decisions. Such statistical bargains have tended to disappear over the years. This may be due to the constant combing and recombing of investments that has occurred during the past 20 years, without an economic convulsion such as that of the 30s to create a negative bias toward equities and spawn hundreds of new bargain securities. It may be due to the new growing social acceptance and therefore usage, or maybe it's vice versa, I'll let the behaviorists figure it out, of takeover bids, which have a natural tendency to focus on bargain issues. It may be due to the exploding ranks of security analysts bringing forth an intensified scrutiny of issues far beyond what existed some years ago. Whatever the cause, the result has been the virtual disappearance of the bargain issue as determined quantitatively, and thereby of our bread and butter. There still may be a few from time to time. There will also be the occasional security where I am really competent to make an important qualitative judgment. This will offer our best chance for large profits. Such instances will, however, be rare. Much of our good performance during the past 3 years has been due to a single idea of this sort. The next point of difficulty is the intensified interest in investment performance. For years I have preached the importance of measurement. Consistently, I have told partners that unless our performance was better than average, the money should go elsewhere. In recent years, this idea has gained momentum throughout the investment, or more importantly the investing, community. In the last year or two, it has started to look a bit like a tidal wave. I think we are witnessing the distortion of a sound idea. I have always cautioned partners that I considered 3 years a minimum in determining whether we were performing. Naturally, as the investment public has taken the bit in its teeth, the time span of expectations has been consistently reduced to the point where investment performance by large aggregates of money is being measured yearly, quarterly, monthly, and perhaps sometimes even more frequently, leading to what is known as instant research. The payoff for superior short-term performance has become enormous, not only in compensation for results actually achieved, but in the attraction of new money for the next round. Thus, a self-generating type of activity has set in which leads to larger and larger amounts of money participating on a shorter and shorter time span. A disturbing corollary is that the vehicle for participation, the particular companies or stocks, becomes progressively less important, at times virtually incidental, as the activity accelerates. In my opinion, what is resulting is speculation on an increasing scale. This is hardly a new phenomenon. However, a dimension has been added by the growing ranks of professional, in many cases formerly quite docile, investors who feel they must get aboard. The game is dignified, of course, by appropriate ceremonies, personages, and lexicon. To date, it has been highly profitable. It may also be that this is going to be the standard nature of the market in the future. Nevertheless, it is an activity at which I am sure I would not do particularly well. As I said on page 5 of my last annual letter, furthermore, we will not follow the frequently prevalent approach of investing in securities where an attempt to anticipate market action overrides business valuations. Such so-called fashion investing has frequently produced very substantial and quick profits in recent years, and currently as I write this in January. It represents an investment technique whose soundness I can neither affirm nor deny. It does not completely satisfy my intellect, or perhaps my prejudices, and most definitely does not fit my temperament. I will not invest my own money based upon such an approach. Hence, I will most certainly not do so with your money. Any form of hyperactivity with large amounts of money in securities markets can create problems for all participants. I make no attempt to guess the action of the stock market, and haven't the foggiest notion as to whether the Dow will be at 600, 900, or 1200 a year from now. Even if there are serious consequences resulting from present and future speculative activity, experience suggests estimates of timing are meaningless. However, I do believe certain conditions that now exist are likely to make activity in markets more difficult for us for the intermediate future. The above may simply be old fogeyism. After all, I am 37. When the game is no longer being played your way, it is only human to say the new approach is all wrong, bound to lead to trouble, etc. I have been scornful of such behavior by others in the past. I have also seen the penalties incurred by those who evaluate conditions as they were, not as they are. Essentially, I am out of step with present conditions. On one point, however, I am clear. I will not abandon a previous approach whose logic I understand, although I find it difficult to apply, even though it may mean foregoing large and apparently easy profits to embrace an approach which I don't fully understand, have not practiced successfully, and which possibly could lead to substantial permanent loss of capital. The third point of difficulty involves our much greater base of capital. For years, my investment ideas were anywhere from 110% to 1,000% of our capital. It was difficult for me to conceive that a different condition could ever exist. I promised to tell partners when it did, and in my January 1967 letter had to make good on that promise. Largely because of the two conditions previously mentioned, our greater capital is now something of a drag on performance. I believe it is the least significant factor of the forementioned, and that if we were operating with 1/10 of our present capital, our performance would be little better. However, increased funds are presently a moderately negative factor. The final and most important consideration concerns personal motivation. When I started the partnership, I set the motor that regulated the treadmill at 10 points better than the Dow. I was younger, poorer, and probably more competitive. Even without the three previously discussed external factors making for poorer performance, I would still feel that changed personal conditions make it advisable to reduce the speed of the treadmill. I have observed many cases of habit patterns in all activities of life, particularly business, continuing and becoming accentuated as years pass, long after they ceased making sense. Bertrand Russell has related the story of two Lithuanian girls who lived at his manor subsequent to World War I. Regularly, each evening after the house was dark, they would sneak out and steal vegetables from the neighbors for hoarding in their rooms. This, despite the fact that food was bountiful at the Russell table. Lord Russell explained to the girls that while such behavior may have made a great deal of sense in Lithuania during the war, it was somewhat out of place in the English countryside. He received assenting nods and continued stealing. He finally contented himself with the observation that their behavior, strange as it might seem to the neighbors, was really not so different from that of the elder Rockefeller. Elementary self-analysis tells me that I will not be capable of less than all-out effort to achieve a publicly proclaimed goal to people who have entrusted their capital to me. All-out effort makes progressively less sense. I would like to have an economic goal which allows for considerable non-economic activity. This may mean activity outside the field of investments, or it simply may mean pursuing lines within the investment field that do not promise the greatest economic reward. An example of the latter might be the continued investment in a satisfactory, but far from spectacular, controlled business where I liked the people and the nature of the business, even though alternative investments offered an expectable higher rate of return. More money would be made buying businesses at attractive prices than reselling them. However, it may be more enjoyable, particularly when the personal value of incremental capital is less, to continue to own them and hopefully improve their performance, usually in a minor way, through some decisions involving financial strategy. Thus I am likely to limit myself to things which are reasonably easy, safe, profitable, and pleasant. This will not make our operation more conservative than in the past, since I believe, undoubtedly with some bias, that we have always operated with considerable conservatism. The long-term downside risk will not be less. The upside potential will merely be less. Specifically, our longer-term goal will be to achieve the lesser of 9% per annum, or a 5 percentage point advantage over the Dow. Thus, if the Dow averages minus 2% over the next 5 years, I would hope to average plus 3%. But if the Dow averages plus 12%, I will hope to achieve an average of only plus 9%. These may be limited objectives, but I consider it no more likely that we will achieve even these more modest results under present conditions than I formerly did that we would achieve our previous goal of a 10 percentage point average annual edge over the Dow. Furthermore, I hope limited objectives will make for more limited effort. I'm quite sure the converse is true. I will incorporate this new goal into the ground rules to be mailed you about November 1st, along with the 1968 commitment letter. I wanted to get this letter off to you prior to that mailing so you would have ample time to consider your personal situation and, if necessary, get in touch with me to clear up some of the enclosed before making a decision on 1968. As always, I intend to continue to leave virtually all of my capital, excluding data document stock, along with that of my family, in BPL. What I consider satisfactory and achievable may well be different from what you consider so. Partners with attractive alternative investment opportunities may logically decide that their funds can be better employed elsewhere, and you can be sure I will be wholly in sympathy with such a decision. I have always found behavior most distasteful which publicly announces one set of goals and motivations when actually an entirely different set of factors prevails. Therefore, I have always tried to be 100% candid with you about my goals and personal feelings so you aren't making important decisions pursuant to phony proclamations. I've run into a few of these in our investment experience. Obviously, all the conditions enumerated in this letter haven't appeared overnight. I have been thinking about some of the points involved for a long period of time. You can understand, I am sure, that I wanted to pick a time when past goals had been achieved to set forth a reduction in future goals. I would not want to reduce the speed of the treadmill unless I had fulfilled my objectives to this point. Please let me know if I can be of any help in deciphering any portion of this letter. Cordially, Warren E. Buffett. January 24, 1968. By most standards, we had a good year in 1967. Our overall performance was plus 35.9% compared to plus 19% for the Dow, thus surpassing our previous objective of performance 10 points superior to the Dow. Our overall gain was $19,384,250, which, even under accelerating inflation, will buy a lot of Pepsi. And, due to the sale of some long-standing large positions in marketable securities, we had realized taxable income of $27,376,667, which has nothing to do with 1967 performance, but should give all of you a feeling of vigorous participation in the Great Society on April 15th. The minor thrills described above are tempered by any close observation of what really took place in the stock market during 1967. Probably a greater percentage of participants in the securities markets did substantially better than the Dow last year than in virtually any year in history. In 1967, for many, it rained gold, and it paid to be out playing the bass tuba. I don't have a final tabulation at this time, but my guess is that at least 95% of investment companies following a common stock program achieved better results than the Dow, in many cases by very substantial amounts. It was a year when profits achieved were in inverse proportion to age, and I am in the geriatric ward philosophically. Last year I said, "A few mutual funds and some private investment operations have compiled records vastly superior to the Dow, and in some cases substantially superior to Buffett Partnership Limited. Their investment techniques are usually very dissimilar to ours and not within my capabilities." In 1967, this condition intensified. Many investment organizations performed substantially better than BPL, with gains ranging to over 100%. Because of these spectacular results, money, talent, and energy are converging in a maximum effort for the achievement of large and quick stock market profits. It looks to me like greatly intensified speculation with concomitant risks, but many of the advocates insist otherwise. My mentor, Ben Graham, used to say, "Speculation is neither illegal, immoral, nor fattening financially." During the past year, it was possible to become fiscally flabby through a steady diet of speculative bonbons. We continue to eat oatmeal, but if indigestion should set in generally, it is unrealistic to expect that we won't have some discomfort. January 24, 1968. Some of those who withdrew, and many who didn't, asked me, "What do you really mean?" after receiving the October 9th letter. This sort of a question is a little bruising to any author, but I assured them I meant exactly what I had said. I was also asked whether this was an initial stage in the phasing out of the partnership. The answer to this is definitely no. As long as partners want to put up their capital alongside of mine, and the business is operationally pleasant, and it couldn't be better, I intend to continue to do business with those who have backed me since tennis shoes. July 11, 1968. The present environment. I make no effort to predict the course of general business or the stock market, period. However, currently there are practices snowballing in the security markets and business world which, while devoid of short-term predictive value, bother me as to possible long-term consequences. I know that some of you are not particularly interested, and shouldn't be, in what is taking place on the financial stage. For those who are, I am enclosing a reprint of an unusually clear and simple article which lays bare just what is occurring on a mushrooming scale. Spectacular amounts of money are being made by those participating, whether as originators, top employees, professional advisors, investment bankers, stock speculators, etc., in the chain letter type stock promotion vogue. The game is being played by the gullible, the self-hypnotized, and the cynical. To create the proper illusions, it frequently requires accounting distortions. One particularly progressive entrepreneur told me he believed in bold imaginative accounting, tricks of capitalization, and camouflage of the true nature of the operating businesses involved. The end product is popular, respectable, and immensely profitable. I'll let the philosophers figure in which order those adjectives should be placed. Quite candidly, our own performance has been substantially improved on an indirect basis because of the fallout from such activities. To create an ever-widening circle of chain letters requires increasing amounts of corporate raw material, and this has caused many intrinsically cheap and not so cheap stocks to come to life. When we have been the owners of such stocks, we have reaped market rewards much more promptly than might otherwise have been the case. The appetite for such companies, however, tends to substantially diminish the number of fundamentally attractive investments which remain. I believe the odds are good that, when the stock market and business history of this period is being written, the phenomenon described in Mr. May's article will be regarded as of major importance, and perhaps characterized as a mania. You should realize, however, that his "the emperor has no clothes" approach is at odds, or dismissed with a "so what" or an enjoy," with the views of most investment banking houses and currently successful investment managers. We live in an investment world, populated not by those who must be logically persuaded to believe, but by the hopeful, credulous, and greedy, grasping for an excuse to believe. Finally, for a magnificent account of the current financial scene, you should hurry out and get a copy of The Money Game by Adam Smith. It is loaded with insights and supreme wit. Note, despite my current Support Your Local Postmaster drive, I am not enclosing the book with this letter. It retails for $6.95. July 11, 1968. Our performance in 1968. Everyone makes mistakes. At the beginning of 1968, I felt prospects for BPL performance looked poorer than at any time in our history. However, due in considerable measure to one simple but sound idea whose time had come, investment ideas, like women, are often more exciting than punctual, we recorded an overall gain of $40,032,691. Naturally, you all possess sufficient intellectual purity to dismiss the dollar result and demand an accounting of performance relative to the Dow Jones Industrial Average. We established a new mark at plus 58.8% versus an overall plus 7.7% for the Dow, including dividends which would have been received through ownership of the average throughout the year. This result should be treated as a freak, like picking up 13 spades in a bridge game. You bid the slam, make it look modest, pocket the money, and then get back to work on the part scores. We will also have our share of hands when we go set. July 11, 1968. Some of the so-called go-go funds have recently been rechristened no-go funds. For example, Gerald Tsai's Manhattan Fund, perhaps the world's best-known aggressive investment vehicle, came in at minus 6.9% for 1968. Many smaller investment entities continued to substantially outperform the general market in 1968, but in nothing like the quantities of 1966 and 1967. July 11, 1968. I can't emphasize too strongly that the quality and quantity of ideas is presently at an all-time low, the product of the factors mentioned in my October 9, 1967 letter, which have largely been intensified since then. Sometimes I feel we should have a plaque in our office like the one at the headquarters of Texas Instruments in Dallas, which reads, "We don't believe in miracles, we rely on them." It is possible for an old, overweight ball player, whose legs and batting eye are gone, to tag a fastball on the nose for a pinch-hit home run, but you don't change your lineup because of it. We have a number of important negatives operating on our future, and while they shouldn't add up to futility, they certainly don't add up to more than an average of quite moderate profitability. Compounded wisdom. We've all heard the adage that history doesn't repeat, but rather it rhymes. The stock market is the same. It goes through cycles. Great investors understand the market's history so they can see the commonality of the cycles and learn what to avoid. It's much cheaper to learn from other people's mistakes than to make them on your own. All serious investors should have an understanding of the ebbs and flows of the last 100 years or so of stock market cycles. Mr. Burke was clearly on to something when he said that those who don't know their history are destined to repeat it. In January 1967, Buffett's year-end letter looks back on the early years, when there were substantial numbers of great ideas to work with, both in generals and workout categories, and the problem was always which, not what, to invest in. 10 years later, the landscape had changed. What started out as a strong flow of good ideas had been reduced to a trickle, and a trickle has considerably more chance of drying up completely than a flow. He makes sure partners understand that he has no intention of altering his investing approach. It is a behavior we would do well to emulate. Go-Go was entering its peak state, and Buffett was aware that many investment organizations did substantially better than BPL in 1967. Some were up more than 100%. The market was getting really frothy, and Buffett saw it. He noted that, because of these spectacular results, money, talent, and energy are converging in a maximum effort for the achievement of large and quick stock market profits. It looks to me like greatly intensified speculation with concomitant risks, but many of the advocates insist otherwise. Buffett was clearly feeling out of step with the market. Jerry Tsai and the performance funds of his generation had taken the Dow to a level where Buffett simply could not find enough good ideas to invest in. What he saw was increasingly dangerous speculation on an increasing scale. The pressure for all money managers to get aboard must have been enormous. While Buffett had no idea how long it would last, or if it was simply the beginning of a new paradigm in the nature of the market, he knew that he wasn't ever going to jump in the pool just because everyone else was swimming. Instead, he chose to close the partnership, and we'll look at how and why he did so next. Chapter 14. Parting Wisdom. We live in an investment world populated not by those who must be logically persuaded to believe, but by the hopeful, credulous, and greedy, grasping for an excuse to believe. July 8, 1968. Buffett's decision to hang it up went beyond the level of the market and the number of ideas he had at the time. The partnership had served its purpose. Through it, he had built up his capital by earning then reinvesting his incentive fees. By May 1969, his net worth had climbed to a staggering $26 million. Munger has said, "If you are highly conscientious and you hate to disappoint, you will feel the pressure to live up to your incentive fee." The partnership was right for Buffett for a time, but now he was ready to move on to a better, more equitable structure. He later recalled the intense internal pressure he was feeling at the time. He never took a performance fee again. At Berkshire, he takes a modest salary and is otherwise directly in alignment with his fellow shareholders. Buffett emphasized in the fall of 1969, saying, "The October 9, 1967 letter stated that personal considerations were the most important factor among those causing me to modify our objectives. I expressed a desire to be relieved of the self-imposed necessity of focusing 100% on BPL. I have flunked this test completely during the last 18 months. I know I don't want to be totally occupied without pacing an investment rabbit all my life. The only way to slow down is to stop." The way Buffett actually went about closing BPL is unique in several different ways. For starters, despite telling partners that he didn't like the prospects for stocks at 1969's prices, he recognized many would still stay in equities regardless. He hand-selected Bill Ruane, who at his request, and ultimately with $20 million in capital from BPL partners, started the Sequoia Fund in 1970. It was a great choice. Ruane's track record was strong over the decade and long after. He became a legendary investor in his own right. Recommending another manager doesn't seem like very logical behavior on the surface. Buffett acknowledged the act was un-Buffett-like. But given many partners had nearly 100% of their net worth on the line, he knew it was the right thing to do no matter how unorthodox. Seeing how Buffett evaluated Ruane offers valuable insight into the important factors at play in choosing any professional manager. Second, Buffett considered the prospects for the market to be quite poor at the time and described something he saw as unprecedented in his own investing lifetime. The 10-year outlook for returns in stocks looked to be on par with the yields on less risky, tax-free municipal bonds. This was a real anomaly. In most market environments, investors have to give up a significant amount of expected return from stocks in exchange for the stability and predictability they'd get from bonds. Not only did Buffett describe how he arrived at his conclusion about bonds, which is brilliant, but he also delivered the contents of a 100-page textbook on tax-free municipal bonds in one simple, precise, and highly digestible 10-page memo. Anyone wishing to understand how bonds work, even if you're not a pro, and even if you are, will benefit from a careful study of this essay, which can be found in full in the appendix. Then he offered to serve as a broker and advisor to partners who wished to follow his recommendations and buy munis. He selected and purchased a unique package of bonds appropriate for each partner's personal needs and circumstance, and had them delivered directly to the partner's bank accounts. While all this was certainly impressive client service, it also highlights an important insight on the interchangeability of investment products. He's reminding partners one last time that the goal is the best after-tax rate of return with the minimum possible amount of risk. It doesn't matter whether this goal is achieved through stocks, bonds, laundromats, or whatever. There is no universal preference for equities. You buy what makes sense, period. Lastly, the way he handled the distribution of the partnership's controls represented the type of fair-minded and communicative style everyone should look for in an investment firm or public company. Controls such as Berkshire Hathaway, Diversified Retailing Corporation, DRC, and blue chip stamps were all distributed to partners pro rata. Because controls were on the books of BPL at a valuation that Buffett alone had determined to be fair, he wanted partners to be able to choose if they wanted their pro rata share of the businesses or their carrying value in cash. Just like at a birthday party where one person cuts the cake and then the others get to choose their pieces, Buffett was leaving it up to partners to freely decide if the controlled businesses or the cash was the bigger piece. When Mungers and another law firm looked at it and realized this option was not going to be possible, he spoke incredibly openly about the prospects for each business, something he has always been reticent to do. Let's take a closer look at all four moves in greater detail. The introduction of Bill Ruane. When Ben Graham was asked to provide his opinion of Buffett as part of a reference check for a potential posting to Geico's board in 1971, Graham said, "I'm 100% for that idea. I have known Buffett intimately for many years, and I must say I have never met anyone else with his combination of high character and brilliant business qualities." It appears Buffett was once again channeling his inner Graham when he introduced Ruane. He also listed integrity before business acumen as the primary attribute. When selecting a manager, that's what has to be first and foremost. The description on Ruane began, "We met in Ben Graham's class at Columbia University in 1951, and I have had considerable opportunity to observe his qualities of character, temperament, and intellect since that time. If Susie and I were to die while our children are minors, he is one of 3 trustees who have carte blanche on investment matters. There is no way to eliminate the possibility of error when judging humans, particularly in regard to future behavior in an unknown environment. However, decisions have to be made, whether actively or passively, and I consider Bill to be an exceptionally high-probability decision on character and a high-probability one on investment performance." In investments, as with most things with Buffett, integrity is what counts first. This was as true then as it remains today. You have to love how he describes the types of managers he seeks out for Berkshire. "We look for 3 things: intelligence, energy, and integrity. If they don't have the latter, then you should hope they don't have the first 2 either. If someone doesn't have integrity, then you want them to be dumb and lazy." Buffett was fully aware that recommending Ruane was risky and unorthodox. In recommending Bill, I am engaging in the sort of activity I have tried to avoid in BPL portfolio activities, a decision where there is nothing to gain personally and considerable to lose. If Ruane's performance was good, Buffett was unlikely to get much credit, but if Ruane did poorly, he was likely to get blamed. It was a heads-you-win, tails-I-lose situation. But, from a moral perspective, he felt he had little choice. Doing nothing didn't seem like a viable option. I feel it would be totally unfair for me to assume a passive position and deliver you to the most persuasive salesman who happened to contact you early in 1970. Buffett was careful to be highly specific about the drawbacks and potential risks in going with Ruane. First off was the question of size. An exceptional manager was apt to grow assets both through performance and capital additions that would inevitably drag down performance. Ruane closed the fund to new investors in 1982 to combat this very problem. In addition to the risk from getting too big, Ruane was operating an investment advisory firm as well as the fund, and would not be exclusively focused on Sequoia. His potential distraction was a risk that Buffett was careful to point out. The recommendation worked out, but it took several years to do so. Ruane's performance figures can be found in Appendix C in the PDF enhancement. He underperformed the S&P in each of the first 4 years, and it wasn't until his 7th year that he finally caught up and began outperforming on a cumulative basis. It's one thing to look back on this performance within a larger historical context. It's entirely something else to live through it, but those who held on were well rewarded. For the decade, Ruane trounced the market, delivering twice the average return per annum. If you are going to pick someone else to manage your funds, you must have a firm belief in their integrity and their ability, as well as a solid understanding of their process. Ruane was a Graham disciple, a true value investor, and highly likely to underperform in the late stages of a bull market top. That way you can make exceptions to your rules, such as a 3 to 5 year relative performance test when you identify the speculative nature of the market. Here's an interesting statistic from Joel Greenblatt, who looked at the top 25% of managers who had outperformed the market over the decade. 97% spent at least 3 years in the bottom half of performance, and 47% spent at least 3 years in the bottom 10%. Buffett's 3 to 5 year test is simply a rule of thumb. If your capital is underperforming in the hands of someone else, you think hard about the choices you've made. Muni bonds, anyone? Ruane was asked to be there for BPL partners wanting to stay in the equity market, but Buffett wanted them to consider the market from a different perspective. For the first time in my investment lifetime, I now believe there is little choice for the average investor between professionally managed money in stocks and passive investment in bonds. If correct, this view has important implications. When it comes to general equity investments in an overextended market, Munger's rule is worth remembering. If something's not worth doing, it's certainly not worth doing well. Buffett described the situation as he saw it for the average 1969 investor in the 40% tax bracket. Tax-free municipal bonds were yielding 6.5 to 7% at the time. Stocks, he thought, were unlikely to rise more than 6% per annum and pay 3% in dividends throughout. To make the tax-free bonds comparable, the 9% maximum pre-tax gains on stocks needed to be reduced. The 6% from price appreciation became 4.75%, and the 3% dividend went to 1.75%, for a combined after-tax return of about 6.5%, the same as what was on offer from the bonds. If Buffett was right about stocks, his muni bonds offered the same yield. The 6.5% from stocks was what he expected the index to deliver. Buffett figured 90% of the funds would underperform. He concluded that, under the historically unusual conditions, Passive investment in tax-free bonds is likely to be fully the equivalent of expectations from professionally managed money in stocks and only modestly inferior to extremely well-managed equity money. Buffett wrote a short treatise on the muni bond market and recommended partners read and reread it several times if they decided to enlist his help in buying these bonds. The choices they had were to buy the bonds, buy stocks, or stay in cash. Whatever they decided, he was trying to spare them the experience of a slick salesperson capable of fleecing them of the returns he had worked so hard to generate for them. In recognition of the difficult question of asset allocation, Buffett wrapped up the October letter, saying, "You will have to make your own decision as between bonds and stocks, and, if the latter, who advises you on such stocks. In many cases, I think the decision should largely reflect your tangible and intangible, temperamental, needs for regularity of income and absence of large principal fluctuation, perhaps balanced against psychic needs for some excitement and the fun associated with contemplating and perhaps enjoying really juicy results. If you would like to talk over the problem with me, I will be very happy to help." Many wise men and women have put plenty of thought and effort into asset allocation questions over the years. From Buffett, we learn that there is no magic formula. You can't just take 100 minus your age and put that percentage in stocks or rely on some other trick or formula. While bonds are often less risky than stocks, it's not a universal truth. Just look at what's on offer in mid-2015. There is no yield in the bond market. Sometimes bonds are less risky, and sometimes they are not. The types of securities you choose are the means to an end. Don't confuse the former with the latter. In any investment, there are two key questions. What is the most likely return, and what's the risk? Today, 10-year U.S. government bonds yield 2.4%, a level just marginally above expected inflation, meaning real yields are negligible. Stocks, typically seen as more risky, sport earnings yields of just under 6%. Despite convention, government bonds appear to be the riskier asset class today. As we've learned, just because something is conventional doesn't mean it's conservative or correct. You have to do your own thinking on it. To Buffett's eye at the beginning of 1970, the only thing that made stocks more attractive than munis was the potential excitement they offered. Control issues. In December 1969, he gave an account of the firm's two controls, then focused on answering questions from partners in response. This represents one of the most detailed accounts he has given on the prospects for a single security, as close to an investment recommendation as we have ever seen him make. My personal opinion is that the intrinsic value of DRC and BH will grow substantially over the years. While no one knows the future, I would be disappointed if such growth wasn't at a rate of approximately 10% per annum. I think both securities should be very decent long-term holdings, and I am happy to have a substantial portion of my net worth invested in them. Should I continue to hold the securities, as I fully expect to do, my degree of involvement in their activities may vary depending upon my other interests. The odds are that I will take an important position on matters of policy, but I want no moral obligation to be other than a passive shareholder. Initially, Buffett's intention was to give partners the option to either 1. Receive their pro rata share of the control companies, or 2. Elect to take the carrying value of the controls in cash. This was immeasurably fair since Buffett had determined the valuation. He felt partners should be able to choose whatever they felt was the more valuable of the two options. Unfortunately, the lawyers wouldn't allow it. All partners would get their share of stock, and if they wished to sell, would have to do so on their own. One interesting question that came up was why he didn't register the shares so that the stocks would be freely marketable. The idea behind the question was that the shares would be more liquid, easier to sell if Buffett had registered them. The bottom line from Buffett on this issue was that partners who wished to sell would be better off without a registration. He felt that, given the market environment at the time, there was a real likelihood that, the market for these two stocks would be little short of chaotic. And he went on to say, "It is my belief that, by confining sales to private placements, those partners who wish to sell will realize more for their stock. We have had several phone calls from persons indicating that they wish to make private sales. We anticipate there will be no difficulty in effectuating such sales at prices related to our year-end valuations." Had Buffett registered the stock, there is a substantial chance that those who wanted or otherwise needed to sell stock would have gotten a lower price than they otherwise did. Buffett made sure that all players were on a level playing field when it came to deciding what they should do with their controls. He insisted upon not talking to partners individually about the three companies. He wanted everyone to be on equal footing, for everyone to have access to the exact same information. He took questions in writing and then included the answers so all partners would benefit. This is how he continues to handle communications at Berkshire Hathaway. To this day, while it's extremely common for large institutional investors to gain an edge over smaller investors through regular private meetings with public company management teams, Buffett refuses to do it. All investors receive the same opportunity once a year at the shareholder meeting in Omaha to ask their questions and have them answered in front of everyone. This idea was as unique then as it remains today. It conveys management's belief that selective disclosure, even if it's of an immaterial nature, is unethical. Given his announced plans to accumulate more stock after the partnership, it was in his best financial interest to say very little. The less he said, the more likely it was that partners would choose to sell their stock. It's amazing to think, especially with hindsight, that anyone actually sold, although many did. Buffett's already substantial stakes in all three at least doubled a year after BPL closed, and all were later fully consolidated into Berkshire at different times. Lessons from the Partnership Letters. Closing Remarks. May 29, 1969. To my partners. About 18 months ago, I wrote to you regarding changed environmental and personal factors causing me to modify our future performance objectives. The investing environment I discussed at that time, and on which I have commented in various other letters, has generally become more negative and frustrating as time has passed. Maybe I am merely suffering from a lack of mental flexibility. One observer, commenting on security analysts over 40, stated, "They know too many things that are no longer true." However, it seems to me that 1. Opportunities for investment that are open to the analyst who stresses quantitative factors have virtually disappeared, after rather steadily drying up over the past 20 years. 2. Our $100 million of assets further eliminates a large portion of this seemingly barren investment world, since commitments of less than about $3 million cannot have a real impact on our overall performance, and this virtually rules out companies with less than about $100 million of common stock at market value. And 3. A swelling interest in investment performance has created an increasingly short-term oriented and, in my opinion, more speculative market. The October 9, 1967 letter stated that personal considerations were the most important factor among those causing me to modify our objectives. I expressed a desire to be relieved of the self-imposed necessity of focusing 100% on BPL. I have flunked this test completely during the last 18 months. The letter said, "I hope limited objectives will make for more limited effort." It hasn't worked out that way. As long as I am on stage, publishing a regular record and assuming responsibility for management of what amounts to virtually 100% of the net worth of many partners, I will never be able to put sustained effort into any non-BPL activity. If I am going to participate publicly, I can't help being competitive. I know I don't want to be totally occupied without pacing an investment rabbit all my life. The only way to slow down is to stop. Therefore, before year end, I intend to give all limited partners the required formal notice of my intention to retire. There are, of course, a number of tax and legal problems in connection with liquidating the partnership, but overall I am concerned with working out a plan that attains the following objectives. 1. The most important item is that I have an alternative regarding money management to suggest to the many partners who do not want to handle this themselves. Some partners, of course, have alternatives of their own in which they have confidence and find quite acceptable. To the others, however, I will not hand over their money with a good luck. I intend to suggest an alternative money manager to whom I will entrust funds of my relatives and others for whom I have lifetime financial responsibility. This manager has integrity and ability and will probably perform as well or better than I would in the future, although nowhere close to what he or I have achieved in the past. He will be available to any partner, so that no minimum size for accounts will cause any of you a problem. I intend, in the future, to keep in general touch with what he is doing, but only on an infrequent basis with any advice on my part largely limited to a negative type. 2. I want all partners to have the option of receiving cash and possibly readily marketable securities. There will probably be only one where this will apply, where I like both the prospects and price, but which partners will be able to freely convert to cash if they wish. 3. However, I also want all partners to have the option of maintaining their proportional interests in our two controlled companies, Diversified Retailing Company, Inc. and Berkshire Hathaway, Inc., and one other small restricted holding. Because these securities will be valued unilaterally by me at fair value, I feel it is essential that if you wish, you can maintain your proportionate interest at such valuation. However, these securities are not freely marketable. Various SEC restrictions apply to control stock and non-registered stock, and they will probably be both non-transferable and non-income producing for a considerable period of time. Therefore, I want you to be able to go either way in our liquidation, either stick with the restricted securities or take cash equivalent. I strongly like all of the people running our controlled businesses, joined now by the Illinois National Bank and Trust Company of Rockford, Illinois, a $100 million plus, extremely well-run bank purchased by Berkshire Hathaway earlier this year, and want the relationship to be lifelong. I certainly have no desire to sell a good controlled business run by people I like and admire merely to obtain a fancy price. However, specific conditions may cause the sale of one operating unit at some point. I believe we will have a liquidation program which will accomplish the above objectives. Our activities in this regard should cause no change in your tax planning for 1969. One final objective I would like very much to achieve, but which just isn't going to happen, is to go out with a bang. I hate to end with a poor year, but we are going to have one in 1969. My best guess is that at year end, allowing for a substantial increase in value of controlled companies, against which all partners except me will have the option of taking cash, we will show a break-even result for 1969 before any monthly payments to partners. This will be true even if the market should advance substantially between now and year-end, since we will not be in any important position which will expose us to much upside potential. Our experience in workouts this year has been atrocious. During this period, I have felt like the bird that inadvertently flew into the middle of a badminton game. We are not alone in such experience, but it came at a time when we were toward the upper limit of what has been our historical range of percentage commitment in this category. Documenting one's boners is unpleasant business. I find selective reporting even more distasteful. Our poor experience this year is 100% my fault. It did not reflect bad luck, but rather an improper assessment of a very fast-developing governmental trend. Paradoxically, I have long believed the government should have been doing, in terms of the problem attacked, not necessarily the means utilized, what it finally did. In other words, on an overall basis, I believe the general goal of the activity, which has cost us substantial money, is socially desirable, and have so preached for some time. Nevertheless, I didn't think it would happen. I never believe in mixing what I think should happen socially with what I think will happen in making decisions. In this case, we would be some millions better off if I had. Quite frankly, in spite of any factors set forth on the earlier pages, I would continue to operate the partnership in 1970 or even 1971 if I had some really first-class ideas. Not because I want to, but simply because I would so much rather end with a good year than a poor one. However, I just don't see anything available that gives any reasonable hope of delivering such a good year, and I have no desire to grope around hoping to get lucky with other people's money. I am not attuned to this market environment, and I don't want to spoil a decent record by trying to play a game I don't understand just so I can go out a hero. Therefore, we will be liquidating holdings throughout the year, working toward a residual of the controlled companies, the one investment letter security, the one marketable security with favorable long-term prospects, and the miscellaneous stubs, etc., of small total value, which will take several years to clean up in the workout category. I have written this letter a little early in lieu of the mid-year letter. Once I made a decision, I wanted you to know. I also wanted to be available in Omaha for a period after you received this letter to clear up anything that may be confusing in it. In July, I expect to be in California. Some of you are going to ask, what do you plan to do? I don't have an answer to that question. I do know that when I am 60, I should be attempting to achieve different personal goals than those which had priority at age 20. Therefore, unless I now divorce myself from the activity that has consumed virtually all of my time and energies during the first 18 years of my adult life, I am unlikely to develop activities that will be appropriate to new circumstances in subsequent years. We will have a letter out in the fall, probably October, elaborating on the liquidation procedure, the investment advisor suggestion, etc. Cordially, Warren E. Buffett. October 9th, 1969. Unless there is a further substantial decline in the market, I still expect about a break-even performance before any monthly payments for 1969. We were lucky. If we had not been in liquidation this year, our results would have been significantly worse. Ideas that looked potentially interesting on a continuing basis have, on balance, performed poorly to date. We have only 2 items of real size left. One we are selling as I write this, and the other is a holding of limited marketability representing about 7.5% of the outstanding stock of blue chip stamps, which we may sell via a registered public offering around year-end, depending upon market conditions and other factors. October 9th, 1969. Bill Ruane. We met in Ben Graham's class at Columbia University in 1951, and I have had considerable opportunity to observe his qualities of character, temperament, and intellect since that time. If Susie and I were to die while our children are minors, he is one of 3 trustees who have carte blanche on investment matters. The other 2 are not available for continuous investment management for all partners, large or small. There is no way to eliminate the possibility of error when judging humans, particularly in regard to future behavior in an unknown environment. However, decisions have to be made, whether actively or passively, and I consider Bill to be an exceptionally high probability decision on character and a high probability one on investment performance. I also consider it likely that Bill will continue as a money manager for many years to come. Bill has recently formed a New York Stock Exchange firm, Ruane, Cuniff & Stiers Incorporated, 85 Broad Street, New York, New York 10004. Telephone number 212-344-6700. John Harding presently plans to establish an office for the firm in Omaha about March 1, 1970. Bill manages accounts individually on a fee basis, and also executes brokerage for the accounts, presently with some portion of the brokerage commissions used to offset a portion of the investment advisory fee. His method of operation allows monthly withdrawals on a basis similar to BPL, as a percentage of capital and unrelated to realized or unrealized gain or loss. It is possible he may form some sort of pooled account, but such determinations will be made between him and those of you who elect to go with him. I, of course, will not be involved with his operation. I am making my list of partners available to him, and he will be writing you fairly soon regarding a trip he plans to make before year-end to Omaha, Los Angeles, and Chicago, so that those of you who wish to meet him may do so. Any of you who are going to be in New York during the next few months can contact him directly. Bill's overall record has been very good, averaging fairly close to BPL's, but with considerably greater variation. From 1956 to 1961, and from 1964 to 1968, a composite of his individual accounts averaged over 40% per annum. However, in 1962, undoubtedly somewhat as a product of the euphoric experience of the earlier years, he was down about 50%. As he reoriented his thinking, 1963 was about break-even. While 2 years may sound like a short time when included in a table of performance, it may feel like a long time when your net worth is down 50%. I think you run this sort of short-term risk with virtually any money manager operating in stocks, and it is a factor to consider in deciding the portion of your capital to commit to equities. To date, in 1969, Bill is down about 15%, which I believe to be fairly typical of most money managers. Bill, of course, has not been in control situations or workouts, which have usually tended to moderate the swings in BPL year-to-year performance. Even excluding these factors, I believe his performance would have been somewhat more volatile, but not necessarily poorer by any means, than mine. His style is different, and while his typical portfolio, under most conditions, would tend to have a mild overlap with mine, there would always be very significant differences. Bill has achieved his results working with an average of $5 to $10 million. I consider the 3 most likely negative factors in his future to be: 1. The probability of managing significantly larger sums. This is a problem you are going to have rather quickly with any successful money manager, and it will tend to moderate performance. I believe Bill's firm is now managing $20 to $30 million, and of course they will continue to add accounts. 2. The possibility of Bill's becoming too involved in the detail of his operation rather than spending all of his time simply thinking about money management. The problems of being the principal factor in a NYSE firm, as well as handling many individual accounts, can mean that he, like most investment advisors, will be subject to pressures to spend much of his time in activities that do nothing to lead to superior investment performance. In this connection, I have asked Bill to make his services available to all BPL partners, large or small, and he will. But I have also told him he is completely a free agent if he finds particular clients diverting him from his main job. 3. The high probability that even excellent investment management during the next decade will only produce limited advantages over passive management. I will comment on this below. The final point regarding the negatives listed above is that they are not the sort of drawbacks leading to horrible performance, but more likely the sort of things that lead to average performance. I think this is the main risk you run with Bill, and average performance is just not that terrible a risk. In recommending Bill, I am engaging in the sort of activity I have tried to avoid in BPL portfolio activities, a decision where there is nothing to gain, personally, and considerable to lose. Some of my friends who are not in the partnership have suggested that I make no recommendation, since, if results were excellent, it would do me no good, and, if something went wrong, I might well get a portion of the blame. If you and I had just had a normal commercial relationship, such reasoning might be sound. However, the degree of trust partners have extended to me, and the cooperation manifested in various ways precludes such a hands-off policy. Many of you are professional investors or close thereto, and need no advice from me on managers. You may well do better yourself. For those partners who are financially inexperienced, I feel it would be totally unfair for me to assume a passive position and deliver you to the most persuasive salesman who happened to contact you early in 1970. October 9th, 1969. A decade or so ago, I was quite willing to set a target of 10 percentage points per annum better than the Dow, with the expectation that the Dow would average about 7%. This meant an expectancy for us of around 17%, with wide variations and no guarantees, of course, but nevertheless an expectancy. Tax-free bonds at the time yielded about 3%. While stocks had the disadvantage of irregular performance, overall they seemed much the more desirable option. I also stressed this preference for stocks in teaching classes, participating in panel discussions, etc. For the first time in my investment lifetime, I now believe there is little choice for the average investor between professionally managed money in stocks and passive investment in bonds. If correct, this view has important implications. Let me briefly, and in somewhat oversimplified form, set out the situation as I see it. 1. I am talking about the situation for, say, a taxpayer in a 40% federal income tax bracket who also has some state income tax to pay. Various changes are being proposed in the tax laws which may adversely affect net results from presently tax-exempt income, capital gains, and perhaps other types of investment income. More proposals will probably come in the future. Overall, I feel such changes over the years will not negate my relative expectations about after-tax income from presently tax-free bonds versus common stocks, and may well even mildly reinforce them. 2. I am talking about expectations over the next 10 years, not the next weeks or months. I find it much easier to think about what should develop over a relatively long period of time than what is likely in any short period. As Ben Graham said, "In the long run, the market is a weighing machine. In the short run, a voting machine." I have always found it easier to evaluate weights dictated by fundamentals than votes dictated by psychology. 3. Purely passive investment in tax-free bonds will now bring about 6.5%. This yield can be achieved with excellent quality and locked up for just about any period for which the investor wishes to contract. Such conditions may not exist in March when Bill and I will be available to assist you in bond purchases, but they exist today. 4. The 10-year expectation for corporate stocks as a group is probably not better than 9% overall, say 3% dividends and 6% gain in value. I would doubt that gross national product grows more than 6% per annum. I don't believe corporate profits are likely to grow significantly as a percentage of GNP, and if earnings multipliers don't change, and with these assumptions and present interest rates they shouldn't, the aggregate valuation of American corporate enterprise should not grow at a long-term compounded rate above 6% per annum. This typical experience in stocks might produce, for the taxpayer described earlier, 1.25% after tax from dividends and 4.75% after tax from capital gain, for a total after-tax return of about 6.5%. The pre-tax mix between dividends and capital gains might be more like 4% and 5%, giving a slightly lower after-tax result. This is not far from historical experience, and overall I believe future tax rules on capital gains are likely to be stiffer than in the past. 5. Finally, probably half the money invested in stocks over the next decade will be professionally managed. Thus, by definition virtually, the total investor experience with professionally managed money will be average results, or 6.5% after tax if my assumptions above are correct. My judgment would be that less than 10% of professionally managed money, which might imply an average of $40 billion just for this superior segment, handled consistently for the decade would average 2 points per annum over group expectancy. So-called aggressively run money is unlikely to do significantly better than the general run of professionally managed money. There is probably $50 billion in various gradations of this aggressive category now, maybe 100 times that of a decade ago, and $50 billion just can't perform. If you are extremely fortunate and select advisors who achieve results in the top 1% to 2% of the country, but who will be working with material sums of money because they are that good, I think it is unlikely you will do much more than 4 points per annum better than the group expectancy. I think the odds are good that Bill Ruane is in this select category. My estimate, therefore, is that over the next decade the results of really excellent management for our typical taxpayer after tax might be 1.75% from dividends and 7.75% from capital gain, or 9.5% overall. 6. The rather startling conclusion is that under today's historically unusual conditions, passive investment in tax-free bonds is likely to be fully the equivalent of expectations from professionally managed money in stocks, and only modestly inferior to extremely well-managed equity money. 7. A word about inflation. It has very little to do with the above calculation, except that it enters into the 6% assumed growth rate in GNP and contributes to the causes producing 6.5% on tax-free bonds. If stocks should produce 8% after tax and bonds 4%, stocks are better to own than bonds, regardless of whether prices go up, down, or sidewise. The converse is true if bonds produce 6.5% after tax and stocks 6%. The simple truth, of course, is that the best expectable after-tax rate of return makes the most sense, given a rising, declining, or stable dollar. All of the above should be viewed with all the suspicion properly accorded to assessments of the future. It does seem to me to be the most realistic evaluation of what is always an uncertain future. I present it with no great feeling regarding its approximate accuracy, but only so you will know what I think at this time. You will have to make your own decision as between bonds and stocks, and if the latter, who advises you on such stocks. In many cases, I think the decision should largely reflect your tangible and intangible, temperamental, needs for regularity of income and absence of large principal fluctuation, perhaps balanced against psychic needs for some excitement and the fun associated with contemplating and perhaps enjoying really juicy results. If you would like to talk over the problem with me, I will be very happy to help. December 5th, 1969. We have various annual reports, audits, interim reports, proxy materials, prospectuses, etc., applicable to our control holdings, and we will be glad to supply you with any item you request. I also solicit your written questions and will send to all partners the questions and answers shortly before year-end. Don't hesitate to ask any question at all that comes to mind. If it isn't clear to you, it probably isn't clear to others, and there is no reason for any of you to be wondering about something that I might clear up. December 5th, 1969. My personal opinion is that the intrinsic value of DRC and BH will grow substantially over the years. While no one knows the future, I would be disappointed if such growth wasn't at a rate of approximately 10% per annum. Market prices for stocks fluctuate at great amplitudes around intrinsic value, but over the long term, intrinsic value is virtually always reflected at some point in market price. Thus, I think both securities should be very decent long-term holdings, and I am happy to have a substantial portion of my net worth invested in them. You should be unconcerned about short-term price action when you own the securities directly, just as you were unconcerned when you owned them indirectly through BPL. I think about them as businesses, not stocks. And if the business does all right over the long term, so will the stock. I want to stress that I will not be in a managerial or partnership status with you regarding your future holdings of such securities. You will be free to do what you wish with your stock in the future, and so of course will I. I think that there is a very high probability that I will maintain my investment in DRC and BH for a very long period, but I want no implied moral commitment to do so, nor do I wish to advise others over an indefinite future period regarding their holdings. The companies, of course, will keep all shareholders advised of their activities, and you will receive reports as issued by them, probably on a semi-annual basis. Should I continue to hold the securities, as I fully expect to do, my degree of involvement in their activities may vary depending upon my other interests. The odds are that I will take an important position on matters of policy, but I want no moral obligation to be other than a passive shareholder, should my interests develop elsewhere. December 5, 1969. If you wish Bill and me to give you our ideas regarding bonds in March, you should purchase U.S. Treasury bills maturing in late March with the applicable portion of the January 5th distribution. Then advise us in the last week of February of the amount you wish to invest in bonds, and we tax basis and acquisition date attributable to the stock. Such shares will be legended, as described in the enclosed letter from Monin, Seidler, and Ryan. These stock certificates are valuable and should be kept in a safe place. December 5, 1969. In past letters I had expressed the hope that BPL could supply a mechanism whereby you could, if you wished, automatically convert your DRC and BH to cash. I have had 2 law firms consider extensively the status of these shares in your hands following the liquidation, and the accompanying letters, which should be saved and kept with the shares, give their conclusions. As you can see, it is not an area that produces simple, clear-cut guidelines. I see no prudent way to implement the alternatives I had previously been considering. Therefore, you must follow the guidelines they set forth if you wish to dispose of your shares. As you probably realize, the restrictions on subsequent sale apply more severely to Susie and me, because of my continued insider position, than they probably do to you. Substantial quantities of securities often are sold via the private sale option described in paragraph 3 of the opinion. If the rules become clearer or more simplified in the future, I will be sure to let you know. At the time of distribution of DRC and BH, I will advise you of the values applied to such shares at 1969 year end. You will receive our audit and tax letter about the end of January. It presently appears that sale of our blue-chip shares and a substantial increase in value of DRC and BH will bring our overall gain for the year to slightly over 6%. December 26, 1969. Various questions have been asked pursuant to the last letter. If we are not getting a good return on the textile business of Berkshire Hathaway Incorporated, why do we continue to operate it? Pretty much for the reasons outlined in my letter. I don't want to liquidate a business employing 1,100 people when the management has worked hard to improve their relative industry position with reasonable results, and as long as the business does not require substantial additional capital investment. I have no desire to trade severe human dislocations for a few percentage points additional return per annum. Obviously, if we faced material compulsory additional investment or sustained operating losses, the decision might have to be different, but I don't anticipate such alternatives. December 26, 1969. Why did you not register our Berkshire Hathaway and diversified retailing shares so that the stock, when received by the partners, would be freely marketable? We considered this possibility, but rejected it for both practical and legal considerations. I will just discuss the practicalities, since they would independently dictate the decision we made. There is presently no existing market for diversified retailing, and our holdings of Berkshire Hathaway are probably 4 or 5 times the present floating supply of this stock. An attempt to quickly buy or sell a few thousand shares can easily move BH stock several points or more. We own 691,441 shares. Were we to distribute these stocks to you via a registration without an underwriting, and with the possibility that a substantial portion would be offered for sale by many sellers operating individually but virtually simultaneously, there is a real likelihood, particularly in a stock market environment such as we have seen recently, that the market for these two stocks would be little short of chaotic. It has not seemed to me that this was the kind of situation with which I should leave you, both from the standpoint of the price level which might prevail, as well as for the reason that different partners might well have to liquidate at widely varying price levels. The more sophisticated partners might have an important edge on the less sophisticated ones, and I believe many partners might have no chance to realize the prices I anticipate using for year-end valuation. This would rightly seem most unfair to you, since I would have received some allocation of 1969 BPL profits based upon these year-end valuations. If the markets were to become distressed, I would probably come in for criticism, whether I personally bought at lower prices, or perhaps more so if I refrained from buying. Were we to attempt to sponsor an underwriting in connection with a registration for those partners who might wish to sell, there would be, in my opinion, the likelihood that the result would still be far less than satisfactory. We have just been around this track with our holdings of blue-chip stamps, where we watched the price of our stock go from 24 to 16.5 after announcement of the underwriting, of which we originally were to be a part. I did not want this sort of result for the partners with respect to their holdings of Berkshire and Diversified. It is my belief that, by confining sales to private placements, those partners who wish to sell will realize more for their stock, with the sophisticated partners having no marketing edge on the less knowledgeable, than would be achieved through an underwriting at this time. Also, the stock should be more likely to find its way into the hands of long-term investment-minded holders, which should mean less volatile markets in the future. We have had several phone calls from persons indicating that they wish to make private sales. We anticipate there will be no difficulty in effectuating such sales at prices related to our year-end valuations. December 26, 1969. Should I hold my BH or DRC stock? I can't give you the answer on this one. All I can say is that I'm going to do so, and I plan to buy more. I am very happy to have a material portion of my net worth invested in these companies on a long-term basis. Obviously, I think they will be worth significantly more money 5 or 10 years hence. Compared to most stocks, I think there is a low risk of loss. I hope their price patterns follow a rather moderate range related to business results, rather than behaving in a volatile manner related to speculative enthusiasm or depression. Obviously, I cannot control the latter phenomena, but there is no intent to promote the stocks a la much of the distasteful general financial market activity of recent years. February 18, 1970. My activity has not been burdened by second-guessing, discussing non-sequiturs, or hand-holding. You have let me play the game without telling me what club to use, how to grip it, or how much better the other players were doing. I've appreciated this, and the results you have achieved have significantly reflected your attitudes and behavior. If you don't feel this is the case, you underestimate the importance of personal encouragement and empathy in maximizing human effort and achievement. Compounded wisdom. The manner in which Buffett went about winding up the partnership provides 3 valuable lessons. First and foremost, the integrity and the genuine care for his partners shines through. From finding a suitable equity manager, to buying bonds for those wishing to follow his advice on munis, to the near explicit recommendation that partners hold on to their stakes in Berkshire and DRC despite his own desire to own more, he put partners first. How much better off would our whole financial services profession be if everyone acted this way? Second, from a practical perspective, we see how he thought about picking managers, and we receive a clinic on the inner workings of the muni bond market. Third, he advises us to think of our securities portfolio as a collection of instruments selected for their combined ability to produce the highest possible rate of tax-free compounding with the minimum amount of risk possible. Nothing illustrates this better than the comparison of what was on offer at the time from stocks in comparison to munis. When it comes to risk and reward, convention and conservatism are once again shown to be independent. Epilogue: Toward a Higher Form. Ben would say that what I do now makes sense, but he would say that it's much harder for most people to do. June 25, 2011. The end of the partnership was just the end of the beginning for Buffett. In 1970, he took on the title of Berkshire's chairman and CEO. By transitioning from a partnership to a corporation, he was evolving to a higher form. In it, he had gained a controlling interest in an entity with permanent capital and the ability to move that capital tax-free from one operating company to another. The partnership mentality, however, hasn't changed a bit. If anything, it's gotten stronger. A corporate partnership. As Buffett sees it, shareholders, just like BPL partners, commingle their capital with his, and together they own the assets of the corporation, just as they had owned the assets in the partnership. Berkshire's owner's manual, the corporate equivalent to the partnership's ground rules, says it all rather explicitly. Although our form is corporate, our attitude is partnership. Charlie Munger and I think of our shareholders as owner-partners and of ourselves as managing partners. Because of the size of our shareholdings, we are also, for better or worse, controlling partners. We do not view the company itself as the ultimate owner of our business assets, but instead view the company as a conduit through which our shareholders own the assets. Not only did Buffett maintain a partnership mentality, he drew even closer into financial alignment with fellow owners because there is no performance fee. At BPL, he took a 25% override on all profits beyond the first 6% for his services as the capital allocator. Since taking the role of chairman of Berkshire, he collects a modest salary, but doesn't take a performance fee or otherwise benefit in any way that is disproportionate his interest as a shareholder. Snapshots versus movie reels. Bill Ruane reportedly once said that when it comes to investing, Graham wrote the Bible and Buffett wrote the New Testament. That sums it up beautifully. It's as if Buffett began as the ultimate Old Testament scholar and then forged his own distinct path. He has been constantly evolving, supplementing and building upon the base of first principles laid down by Graham. A good deal of this evolution occurred throughout the partnership years, where we have seen a willingness to concentrate his investments to greater and greater degrees, a steady migration toward quality compounders from statistically cheap cigar butts, and the forging of his highly unique ability to break down the distinction between assets and capital in a way that allows for their fungibility in the pursuit of higher returns. He starts with an early focus on statistical snapshots of corporate balance sheets, where he would find the very cheapest of the small and micro-cap nets and cigar butts available. Then, in his earliest deviation from his mentor's method, he pursued an extreme level of portfolio concentration. While Graham liked to be well diversified and never took big bets, when Buffett saw a sure thing like Sanborn Map, he loaded up to 1/3 of his capital into a single idea. Buffett goes on to gain an increasing appreciation for the qualitative measures of value. Graham's methods had allowed him to see the cheapness of a company's stock in a way that was like taking a photograph. It produced a statistical snapshot of a company at a signal moment in time. The qualitative method that Buffett slowly came around to was more like taking a video. He began to look beyond today's value and increasingly began to appreciate where that value was headed. The high-quality companies like the Walt Disney Company or American Express gain in intrinsic value over time because they are advantaged in some way. The quantitative cigar butt ideas of Graham are more of a sure thing, but typically offer a single free puff. Buffett came to increasingly appreciate the high-quality businesses that compound their value over time. Buffett gives Charlie Munger, his West Coast philosopher, the credit for slowly tugging him away from the cigar butts and the exhausting hunts for their free puffs. 20 years after the partnership ended, the door to Just Cheap was closed permanently when he summarized his evolved view by saying, "It's better to buy a wonderful business at a fair price than a fair company at a wonderful price." Charlie understood this early. I was a slow learner. But now, when buying companies or common stocks, we look for first-class businesses accompanied by first-class managements. The crossover from searching for Graham-style free puffs to paying a fair price for a very long smoke would come to define a significant portion of Buffett's contributions to his evolved approach. While this was clearly different from what Graham had been doing, it was not incongruent. As Buffett said, "Ben felt that what I do now makes sense for my situation. It still has its founding in Graham, but it does have more of a qualitative dimension to it, because for one thing we manage such large sums of money that you can't go around and find these relatively small price-value discrepancies anymore. Instead, we have to place larger bets, and that involves looking at more criteria, not all of them quantitative. But Ben would say that what I do now makes sense, but he would say that it's much harder for most people to do." The shift from quantitative to qualitative was evolutionary, not revolutionary. Nothing from Graham or early Buffett has been nullified. It was simply added upon. Seeing the field. Graham always said that investing is done best when it's most businesslike, and business is done best when it's most investment-like. Buffett not only exemplifies this idea, but he also furthers it by tearing down the distinction between the two terms. He sees equities as simply the conduit through which shareholders literally own their portion of the assets held within a corporation. The assets themselves can be bought or sold and are therefore fungible. Assets are simply a form of capital in a given state. It's the corporation's and the investor's responsibility alike to maintain the state of their capital in the highest and most productive form possible. Buffett converted corporate assets of poor quality into capital, which in turn was converted back into assets that were more productive. At Dempster, this meant converting unproductive inventory into highly productive securities. At Berkshire, this meant converting low-returning assets tied up in textiles and redeploying them into highly productive insurance and banking assets. Bedrock principles taken to higher levels. The arc of the evolution of Warren Buffett's investment process continues to break new ground. His sterling reputation, coupled with his investing acumen, has opened up an exclusive field of investment for Berkshire over the decades. Recently, he has received unique access to securities like the high-coupon preferred shares of Bank of America, Goldman Sachs, and General Electric during the financial crisis. He not only has had a hand in designing them, but they are made available for Berkshire alone to purchase. Perhaps the most remarkable thing of all is the internal consistency throughout all of his letters, despite the evolution in his methods. No ideas are later nullified or in need of revision. There is really nothing about a 1957 letter, for example, that has become intellectually inconsistent with any other letter since. Instead, ideas are supplemented, nurtured, or simply left intact. With deeper insights and different circumstances, more money, fewer potential investments, the old ideas don't get replaced, they just get less useful to him. Meaning, of course, they can still be useful to us. Buffett leaves us a roadmap that is invaluable for students and investors alike. It's as if he's laid down a challenge to all of us. It's as if he has written the letters, made them public, and said, "Here's how to invest. Here's how I did it. This is the road I took. Now let's see if you can follow me down the path." Appendices A through D can be found on the accompanying PDF enhancement. Appendix E. Buffett's Last Letter. The Mechanics of Tax-Free Municipal Bonds. February 25, 1970. To my partners. This letter will attempt to provide a very elementary education regarding tax-exempt bonds, with emphasis on the types and maturities of bonds which we expect to help partners in purchasing next month. If you expect to use our help in the purchase of bonds, It is important that you carefully read, and if necessary reread this letter, as it will serve as background for the specific purchases I suggest. If you disagree with me as to conclusions regarding types of bonds or maturities, and you would have been right and I would have been wrong if you had disagreed with me on the latter point either 1 or 2 years ago, you may well be correct, but we cannot be of assistance to you in the purchase of bonds outside our area. We will simply have our hands full concentrating in our recommended area, so we'll be unavailable to assist or advise in the purchase of convertible bonds, corporate bonds, or short-term issues. I have tried to boil this letter down as much as possible. Some of it will be a little weighty, some a little oversimplified. I apologize for the shortcomings in advance. I have a feeling I am trying to put all the meat of a 100-page book in 10 pages and have it read like the funny papers. I am sure you understand that our aid in the purchase of bonds will involve no future assistance regarding either these specific bonds or general investment decisions. I want to be available at this time to be of help because of the unusual amount of cash you have received in one distribution from us. I have no desire to be in the investment counseling business directly or indirectly, and will not be available for discussion of financial matters after March 31st. The mechanics of tax-free bonds. For those who wish our help, we will arrange the purchase of bonds directly from municipal bond dealers throughout the country and have them confirm sale of the bonds directly to you. The confirmation should be saved as a basic document for tax purposes. You should not send a check to the bond dealer, since he will deliver the bonds to your bank along with a draft which the bank will pay by charging your account with them. In the case of bonds purchased in the secondary market, issues already outstanding, this settlement date will usually be about a week after confirmation date, whereas on new issues, the settlement date may be as much as a month later. The settlement date is shown plainly on the confirmation ticket. In the case of new issues, this will be the second and final ticket rather than the preliminary when issued ticket, and you should have the funds at your bank ready to pay for the bonds on the settlement date. If you presently own Treasury bills, they can be sold on a couple of days' notice by your bank upon your instructions, so you should experience no problems in having the money available on time. Interest begins to accrue to you on the settlement date, even if the bond dealer is late in getting them delivered to your bank. Bonds will be delivered in negotiable form, so-called bearer form, which makes them like currency, with coupons attached. Usually, the bonds are in $5,000 denominations, and frequently they can be exchanged for registered bonds, sometimes at considerable expense and sometimes free, it depends upon the terms. Bonds in registered form are non-negotiable without assignment by you, since you are the registered owner on the transfer agent's books. Bonds trade almost exclusively on a bearer basis, and it is virtually impossible to sell registered bonds without converting them back into bearer form. Thus, unless you are going to own great physical quantities of bonds, I recommend keeping bonds in bearer form. This means keeping them in a very safe place and clipping the coupons every 6 months. Such coupons, when clipped, can be deposited in your bank account just like checks. If you have $250,000 in bonds, this probably means about 50 separate pieces of paper, $5,000 denominations, and perhaps 6 or 8 trips a year to the safe deposit section to cut and deposit coupons. It is also possible to open a custody account with a bank where, for a fairly nominal cost, they will keep the bonds, collect the interest, and preserve your records for you. For example, a bank will probably perform the custodial service for you for about $200 a year on a $250,000 portfolio. If you are interested in a custodial account, you should talk to a trust officer at your commercial bank as to the nature of their services and cost. Otherwise, you should have a safe deposit box. Taxation. The interest received upon the deposit of coupons from tax-free bonds is, of course, free from federal income taxes. This means if you are at a 30% top federal income tax bracket, A 6% return from tax-free bonds is equivalent to about 8.5% from taxable bonds. Thus, for most of our partners, excluding minors or some retired people, tax-free bonds will be more attractive than taxable bonds. For people with little or no income from wages or dividends, but with substantial capital, it is possible that a combination of taxable bonds to bring taxable income up to about the 25% or 30% bracket, plus tax-free bonds will bring the highest total after-tax income. Where appropriate, we will work with you to achieve such a balance. The situation in respect to state income taxes is more complicated. In Nebraska, where the state income tax is computed as a percentage of the federal income tax, the effect is that there is no state tax on interest from tax-free bonds. My understanding of both the New York and California law is that tax-free bonds of entities within the home state are not subject to state income tax, but tax-free bonds from other states are subject to the local state income tax. I also believe that the New York City income tax exempts tax-free bonds of entities based within the state of New York, but taxes those from other states. I am no expert on state income taxes and make no attempt to post myself on changes taking place within the various states or cities. Therefore, I defer to your local tax advisor, but simply mention these few general impressions so that you will be alert to the existence of a potential problem. In Nebraska, there is no need to have any local considerations enter into the after-tax calculation. Where out-of-state issues are subject to local taxation, the effective cost of your state or municipal income tax is reduced by the benefit received from deducting it on your federal income tax return. This, of course, varies with the individual. Additionally, in some states there are various taxes on intangible property which may apply to all tax-free bonds or just those of out-of-state entities. There are none of these in Nebraska, but I cannot advise on the other states. When bonds are bought at a discount from par and later are sold or mature, come due and get paid, the difference between the proceeds and cost is subject to capital gain or loss treatment. There are minor exceptions to this statement, as unfortunately there are to most general statements on investments and taxes, but they will be pointed out to you should they affect any securities we recommend. This reduces the net after-tax yield by a factor involving the general rate of future capital gains taxes and the specific future tax position of the individual. Later on, we will discuss the impact of such capital gains taxes in calculating the relative attractiveness of discount bonds versus full coupon bonds. Finally, one most important point. Although the law is not completely clear, you should probably not contemplate owning tax-free bonds if you have, or expect to have, general-purpose bank or other indebtedness. The law excludes the deductibility of interest on loans incurred or continued to purchase or carry tax-free bonds, and the interpretation of this statute will probably tend to be broadened as the years pass. For example, my impression is that you have no problem if you have a mortgage against real property, unless the debt was incurred in order to acquire municipal bonds, in deducting the mortgage interest on your federal tax return, even though you own tax-free bonds at the same time. However, I believe that if you have a general bank loan, even though the proceeds were directly used to purchase stocks, a handball court, etc., and the tax-free bonds are not used for security for the loan, you are asking for trouble if you deduct the interest and at the same time are the owner of tax-free bonds. Therefore, I would pay off bank loans before owning tax-free bonds, but I leave detailed examination of this question to you and your tax advisor. I merely mention it to make you aware of the potential problem. Marketability. Tax-free bonds are materially different from common stocks or corporate bonds in that there are literally hundreds of thousands of issues, with the great majority having very few holders. This substantially inhibits the development of close, active markets. Whenever the city of New York or Philadelphia wants to raise money, it sells perhaps 20, 30, or 40 non-identical securities since it will offer an issue with that many different maturities. A 6% bond of New York coming due in 1980 is a different animal from a 6% bond of New York coming due in 1981. One cannot be exchanged for the other, and a seller has to find a buyer for the specific item he holds. When you consider that New York may offer bonds several times a year, it is easy to see why just this one city may have somewhere in the neighborhood of 1,000 issues outstanding. Grand Island, Nebraska may have 75 issues outstanding. The average amount of each issue might be $100,000, and the average number of holders may be 6 or 8 per issue. Thus, it is absolutely impossible to have quoted markets at all times for all issues, and spreads between bids and offers may be very wide. You can't set forth in the morning to buy a specific Grand Island issue of your choosing. It may not be offered at any price anywhere, and if you do find one seller, there is no reason why he has to be realistic compared to other offerings of similar quality. On the other hand, there are single issues, such as those of the Ohio Turnpike, Illinois Turnpike, etc., that amount to $200 million or more and have thousands of bondholders owning a single entirely homogeneous and interchangeable issue. Obviously, here you get a high degree of marketability. My impression is that marketability is generally a function of the following 3 items in descending order of importance. 1. The size of the particular issue. 2. The size of the issuer. A $100,000 issue of the state of Ohio will be more marketable than a $100,000 issue of Podunk, Ohio. And 3. The quality of the issuer. By far, the most sales effort goes into the selling of new issues of bonds. An average of over $200 million per week of new issues comes up for sale, and the machinery of bond distribution is geared to get them sold, large or small. In my opinion, there is frequently insufficient differential in yield at time of issue for the marketability differences that will exist once the initial sales push is terminated. We have frequently run into markets in bonds where the spread between bid and asked prices may get to 15%. There is no need to buy bonds with the potential for such grotesque markets, although the profit spread to the dealer who originally offers them is frequently wider than on more marketable bonds, and we will not be buying them for you. The bonds we expect to buy will usually tend to have spreads reflecting the difference between what you would pay net for such bonds on purchase and receive net on sale at the same point in time, of from 2% to 5%. Such a spread would be devastating if you attempted to trade in such bonds, but I don't believe it should be a deterrent for a long-term investor. The real necessity is to stay away from bonds of very limited marketability, which frequently are the type local bond dealers have the greatest monetary incentive to push. Specific areas of purchase. We will probably concentrate our purchases in the following general areas. 1. Large revenue-producing public entities such as toll roads, electric power districts, water districts, etc. Many of these issues possess high marketability, are subject to quantitative analysis, and sometimes have favorable sinking fund or other factors which tend not to receive full valuation in the marketplace. 2. Industrial Development Authority bonds, which arise when a public entity holds title to property leased to a private corporation. For example, Lorain, Ohio holds title to an $80 million project for U.S. Steel Corporation. The Development Authority Board issued bonds to pay for the project and has executed a net and absolute lease with U.S. Steel to cover the bond payments. The credit of the city or state is not behind the bonds, and they are only as good as the company that is on the lease. Many top-grade corporations stand behind an aggregate of several $billion of these obligations, although new ones are being issued only in small amounts, $5 million per project or less, because of changes in the tax laws. For a period of time, there was a very substantial prejudice against such issues, causing them to sell at yields considerably higher than those commensurate with their inherent credit standing. This prejudice has tended to diminish, reducing the premium yields available, but I still consider it a most attractive field. Our insurance company owns a majority of its bonds in this category. 3. Public Housing Authority issues for those of you who wish the very highest grade of tax-free bonds. In effect, these bonds bear the guarantee of the U.S. government, so they are all rated AAA. In states where local taxes put a premium on buying in-state issues, and I can't fill your needs from 1 and 2, my tendency would be to put you into housing authority issues rather than try to select from among credits that I don't understand. If you direct me to buy obligations of your home state, you should expect substantial quantities of housing authority issues. There is no need to diversify among such issues, as they all represent the top credit available. 4. State obligations of a direct or indirect nature. You will notice I am not buying issues of large cities. I don't have the faintest idea how to analyze a New York City, Chicago, Philadelphia, etc. A friend mentioned the other day when Newark was trying to sell bonds at a very fancy rate that the mafia was getting very upset because Newark was giving them a bad name. Your analysis of a New York City, and I admit it is hard to imagine them not paying their bills for any extended period of time, would be as good as mine. My approach to bonds is pretty much like my approach to stocks. If I can't understand something, I tend to forget it. Passing an opportunity which I don't understand, even if someone else is perceptive enough to analyze it and get paid well for doing it, doesn't bother me. All I want to be sure of is that I get paid well for the things I do feel capable of handling, and that I am right when I make affirmative decisions. We will probably tend to purchase somewhere between 5 and 10 issues for most of you. However, if you wish to limit me to your home state, it may be fewer issues, and perhaps those will only be housing authorities. We will try not to buy in smaller than $25,000 pieces, and will prefer larger amounts where appropriate. Smaller lots of bonds are usually penalized upon resale, sometimes substantially. The bond salesman doesn't usually explain this to you when you buy the $10,000 of bonds from him, but it gets explained when you later try to sell the $10,000 to him. We may make exceptions where we are buying secondary market issues in smaller pieces, but only if we are getting an especially good price on the buy side because of the small size of the offering. Callable bonds. We will not buy bonds where the issuer of the bonds has a right to call, retire, the bonds on a basis which substantially loads the contract in his favor. It is amazing to me to see people buy bonds which are due in 40 years, but where the issuer has the right to call the bonds at a tiny premium in 5 or 10 years. Such a contract essentially means that you have made a 40-year deal if it is advantageous to the issuer, and disadvantageous to you, and a 5-year deal if the initial contract turns out to be advantageous to you and disadvantageous to the issuer. Such contracts are really outrageous, and exist because bond investors can't think through the implications of such a contract form, and bond dealers don't insist on better terms for their customers. One extremely interesting fact is that bonds with very unattractive call features sell at virtually the same yield as otherwise identical bonds which are non-callable. It should be pointed out that most Nebraska bonds carry highly unfair call provisions. Despite this severe contractual disadvantage, they do not offer higher yields than bonds with more equitable terms. One way to avoid this problem is to buy bonds which are totally non-callable. Another way is to buy discount bonds where the right of the issuer to call the bond is at a price so far above your cost as to render the possible call inconsequential. If you buy a bond at 60, which is callable at 103, the effective cost to you of granting the issuer the right to prematurely terminate the contract, which is a right you never have, is insignificant. But to buy a bond of the Los Angeles Department of Water and Power at 100 to come due at 100 in 1999 or to come due at 104 in 1974, depending on which is to the advantage of the issuer and to your disadvantage, is the height of foolishness, when comparable yields are available on similar credits without such an unfair contract. Nevertheless, just such a bond was issued in October 1969, and similar bonds continued to be issued every day. I only write at such length about an obvious point, since it is apparent from the continual sale of such bonds that many investors haven't the faintest notion how this loads the dice against them, and many bond salesmen aren't about to tell them. Maturity and the mathematics of bonds. Many people, in buying bonds, select maturities based on how long they think they are going to want to hold bonds, how long they are going to live, etc. While this is not a silly approach, it is not necessarily the most logical. The primary determinants in selection of maturity should probably be 1. The shape of the yield curve, 2. Your expectations regarding future levels of interest rates, and 3. The degree of quotational fluctuation you are willing to endure or hope to possibly profit from. Of course, 2 is the most important, but by far the most difficult upon which to comment intelligently. Let's tackle the yield curve first. When other aspects of quality are identical, there will be a difference in interest rates paid based upon the length of the bond being offered. For example, a top-grade bond being offered now might have a yield of 4.75% if it came due in 6 or 9 months, 5% in 2 years, 5.25% in 5 years, 5.5% in 10 years, and 6.25% in 20 years. When long rates are substantially higher than short rates, the curve is said to be strongly positive. In the U.S. government bond market, rates recently have tended to produce a negative yield curve. That is, a long-term government bond over the last year or so has consistently yielded less than a short-term one. Sometimes the yield curve has been very flat, and sometimes it is positive out to a given point, such as 10 years, and then flattens out. What you should understand is that it varies, often very substantially, and that on an historical basis the present slope tends to be in the high positive range. This doesn't mean that long bonds are going to be worth more, but it does mean that you are being paid more to extend maturity than in many periods. If yields remain constant for several years, you would do better with longer bonds than shorter bonds, regardless of how long you intended to hold them. The second factor in determining maturity selection is expectations regarding future rate levels. Anyone who has done much predicting in this field has tended to look very foolish very fast. I did not regard rates as unattractive 1 year ago, and I was proved very wrong almost immediately. I believe present rates are not unattractive, and I may look foolish again. Nevertheless, a decision has to be made, and you can make just as great a mistake if you buy short-term securities now, and rates available on reinvestment in a few years are much lower. The final factor involves your tolerance for quotational fluctuation. This involves the mathematics of bond investment, and may be a little difficult for you to understand. Nevertheless, it is important that you get a general grasp of the principles. Let's assume for the moment a perfectly flat yield curve and a non-callable bond. Further assume present rates are 5% and that you buy 2 bonds, one due in 2 years and one due in 20 years. Now assume 1 year later that yields on new issues have gone to 3% and that you wish to sell your bonds. Forgetting about market spreads, commissions, etc., you will receive $1,019.60 for the original 2-year $1,000 bond, now with 1 year to run, and $1,288.10 for the 19-year bond, originally 20 years. At these prices, a purchaser will get exactly 3% on his money after amortizing the premium he has paid and cashing the stream of 5% coupons attached to each bond. It is a matter of indifference to him whether to buy your 19-year 5% bond at $1,288.10 or a new 3% bond, which we have assumed is the rate current 1 year later, at $1,000. On the other hand, let's assume rates went to 7%. Again, we will ignore commissions, capital gains taxes on the discount, etc. Now the buyer will only pay $981 for the bond with 1 year remaining until maturity and $791.60 for the bond with 19 years left. Since he can get 7% on new issues, he is only willing to buy your bond at a discount sufficient so that accrual of this discount will give him the same economic benefits from your 5% coupon that a 7% coupon at $1,000 would give him. The principle is simple. The wider the swings in interest rates and the longer the bond, the more the value of a bond can go up or down on an interim basis before maturity. It should be pointed out in the first example where rates went to 3%. Our long-term bond would only have appreciated to about $1,070 if it had been callable in 5 years at par, although it would have gone down just as much if 7% rates had occurred. This just illustrates the inherent unfairness of call provisions. For over 2 decades, interest rates on tax-free bonds have almost continuously gone higher, and buyers of long-term bonds have continuously suffered. This does not mean it is bad now to buy long-term bonds. It simply means that the illustration in the above paragraph has worked in only one direction for a long period of time, and people are much more conscious of the downside risks from higher rates than the upside potential from lower ones. If it is a 50-50 chance as to the future general level of interest rates and the yield curve is substantially positive, then the odds are better in buying long-term non-callable bonds than shorter-term ones. This reflects my current conclusion, and therefore I intend to buy bonds within the 10 to 25-year range. If you have any preferences within that range, we will try to select bonds reflecting such preferences. But if you are interested in shorter-term bonds, we will not be able to help you as we are not searching out bonds in this area. Before you decide to buy a 20-year bond, go back and read the paragraph showing how prices change based upon changes in interest rates. Of course, if you hold the bond straight through, you are going to get the contracted rate of interest, but if you sell earlier, you are going to be subject to the mathematical forces described in that paragraph, for better or for worse. Bond prices also change because of changes in quality over the years, but in the tax-free area, this has tended to be, and probably will continue to be, a relatively minor factor compared to the impact of changes in the general structure of interest rates. Discount versus full coupon bonds. You will have noticed in the above discussion that if you now wanted to buy a 7% return on a 19-year bond, you had a choice between buying a new 19-year bond with a 7% coupon rate or buying a bond with a 5% coupon at $791.60, which would pay you $1,000 in 19 years. Either purchase would have yielded exactly 7% compounded semi-annually to you. Mathematically, they are the same. In the case of tax-free bonds, the equation is complicated, however, by the fact that the $70 coupon is entirely tax-free to you, whereas the bond purchased at a discount gives you tax-free income of $50 per year, but a capital gain at the end of the 19th year of $208.40. Under the present tax law, you would owe anything from a nominal tax if the gain from realization of the discount was your only taxable income in the 19th year, up to a tax of over $70 if it came on top of very large amounts of capital gain at that time. The new tax law provides for capital gain rates of 35% and even slightly higher on an indirect basis in 1972, and thereafter for those realizing very large gains. In addition to this, you might have some state taxes to pay on the capital gain. Obviously, under these circumstances, you are not going to pay the $791.60 for the 5% coupon and feel you are equally as well off as with the 7% coupon at $1,000. Neither is anyone else. Therefore, identical quality securities with identical maturities sell at considerably higher gross yields when they have low coupons and are priced at discounts than if they bear current high coupons. Interestingly enough, for most taxpayers, such higher gross yields overcompensate for the probable tax to be paid. This is due to several factors. First, no one knows what the tax law will be when the bonds mature, and it is both natural and probably correct to assume the tax rate will be stiffer at that time than now. Second, even though a 5% coupon on a $1,000 bond purchased at $791.60, due in 19 years, is the equivalent of a 7% coupon on a $1,000 bond purchased at par with the same maturity. People prefer to get the higher current return in their pocket. The owner of the 5% coupon bond is only getting around 6.3% current yield on his $791.60, with the balance necessary to get him up to 7% coming from the extra $208.40 he picks up at the end. Finally, the most important factor affecting prices currently on discount bonds, and which will keep affecting them, is that banks have been taken out of the market as buyers of discount tax-free bonds by changes brought about in bank tax treatment through the 1969 Tax Reform Act. Banks have historically been the largest purchasers and owners of tax-free bonds, and anything that precludes them from one segment of the market has dramatic effects on the supply-demand situation in that segment. This may tend to give some edge to individuals in the discount tax-free market, particularly those who are not likely to be in a high tax bracket when the bonds mature or are sold. If I can get a significantly higher effective after-tax yield, allowing for sensible estimates of your particular future tax rate possibilities, I intend to purchase discount bonds for you. I know some partners prefer full coupon bonds, even though their effective yield is less, since they prefer to maximize the current cash yield, and if they will so advise me, we will stick to full coupon issues, or very close thereto, in their cases. Procedure. I intend to be in the office solidly through March, including every Saturday except March 7th, and will be glad to see any partner or talk with him by phone. To aid in scheduling, please make an appointment with Gladys or me. The only request I make is that you absorb as much as possible of this letter before we talk. As you can see, it would be an enormous problem if I had to explain each item to all of you. If you decide you want us to help you in buying bonds, you should let us know 1. Whether you want to restrict purchases to your home state for local tax reasons, 2. Whether you want to restrict us to full coupon issues or let us use our judgment as to where you get the best value, 3. Your preference as to maturity in the 10 to 25-year range, or if you prefer to let us use our judgment in that area, 4. How much you want to invest. We may end up several percent short of the figure you name, but we will never go over. 5. On what bank the bonds should be drafted. We will advise you by phone or letter as we buy bonds. Bill and John will be doing much of the mechanical work. Needless to say, none of us will have any financial interest in any transaction. Should you have any questions regarding the mechanics, please direct them to John or Bill, as I will probably be swamped, and they will be more familiar with specific transactions. After March 31st, I don't expect to be around the office for several months. Therefore, if you want to talk things over, come in by then. The completion of all purchases may go into April, but Bill will be taking care of this and the mechanics will all be set up. You should realize that, because of the enormous diversity of issues mentioned earlier, it is impossible to say just what will be bought. Sometimes the tax-free bond market has more similarities to real estate than to stocks. There are hundreds of thousands of items of varying comparability, some with no sellers, some with reluctant sellers, and some with eager sellers. Which may be the best buy depends on the quality of what is being offered, how well it fits your needs, and the eagerness of the seller. The standard of comparison is always new issues where an average of several $100 million worth have to be sold each week. However, specific secondary market opportunities, issues already outstanding, may be more attractive than new issues, and we can only find out how attractive they are when we are ready to make bids. Although markets can change, it looks as if we will have no difficulty in getting in the area of 6.5% after tax, except from housing authority issues, on bonds in the 20-year maturity range. Cordially, Warren E. Buffett.